Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Big news in the world of kind of digital advertising. Google partially loses U.S. advertising tech antitrust case. So a federal judge found Google guilty of illegally monopolizing online advertising technology markets for advertising exchanges and tools used by websites to sell ad space. To figure out what all that means, we've got some smart people who do this. We have people at Bloomberg Intelligence that just look at litigation and what it means for certain companies, because that can move stocks in a big, big way. We've got a couple of voices here. The one you know, Jennifer Rhee, a Bloomberg Intelligence senior litigation analyst. We've talked to her for a long time. She helps us out on a lot of these big cases. Now we've got another voice as well on Bloomberg Intelligence, Justin Teresi, Bloomberg Intelligence antitrust litigation and policy analyst. He's down there in D.C. right now. Jen, talk to us about Google here. What did the court find here?
Yeah, this is a really complicated case, honestly, Paul. Google has these products, which you refer to. It's called the ad tech stack. And it's not something, normal consumers know about, but it's a series of software from start to finish whereby publishers and advertisers can come together to sell and buy space on the internet, right? And it's important because it's moving very quickly and lining up the ads properly, with the consumers that should see those ads. Google actually has, through a series of acquisitions and some of its own products, control over that entire stack. It has competitors for certain pieces, but it's one of the only ones that has all the pieces. And so the allegation here was that Google was manipulating its control over some very desirable pieces of the stack to force publishers and advertisers to use all of its products, taking fees all along the way and basically naming its price because it had these must-have products. So what this judge found was that for some of those products, one on the publisher side, the publisher ad server, and then the ad exchange that sits right in the middle and does the auction between the advertiser and the publisher, that Google was monopolizing both of those products and also illegally tying them together, meaning, hey, publishers and advertisers, if you want to use our ad exchange where we have these really desirable advertisers, you have to use our publisher ad server, and therefore we keep our 90% or so market share.
All right, Justin, let's bring you in here to just get your take on the context of Google, because this isn't the first time that there's been an antitrust case against Google. What did you make of this decision?
Yeah, absolutely. And I think Jen really hit the nail on the head here. This is obviously compounding the search ruling that came out last year. And we're heading to a remedies phase on that case this coming Monday. But to Jen's point, really, this aspect of the ruling, focusing on the publisher ad server and that exchange that Jen said sits in the middle, that is the crux of the case here. The government's going to likely ask now for divestitures of that publisher ad server and the ad exchange in the middle. But I really do question whether or not the court is in a position to order that. I think a lot of testimony at the trial, which I attended, really pointed to the fact that publishers feel reliant on the ad server because the ad exchange in the middle then gives them the real-time advertising they want from Google Ads. So if you skip that court in the middle, perhaps you get a remedy that's desirable without actually forcing a divestiture out of either of those properties.
Justin, I wonder, at the trial, who do they get to get up on the stand and say, I don't like Google? Doesn't everybody is anybody really complaining about Google and its advertising service?
Yeah, Paul, I think really who's complaining is the publishers who are selling that space on their websites through the publisher ad server, right? I think their complaint is largely that they don't really have a lot of control over the kind of ads that end up on their website. They don't have control over the pricing involved with all of that. They don't really like the fees that are involved. And if they want to use a different ad exchange in the middle, perhaps, and find a lower rate, that they're paying to get those ads furnished to their website or want to collect a higher fee, they're not able to do that if they're really relying upon the prices and the policies that Google is using to display those ads on their properties.
What did Google say in response?
Well, Google would say, look, we have loads of competitors for these products. They sort of pick apart the policies that the Department of Justice pointed to, saying that you're forcing these companies to use your product, saying, no, based on these policies, they're not forced. They have options. They can go to our competitors. And by the way, there's this doctrine in antitrust, and it's called a refusal to deal. And essentially, it's a big defense that's used by a lot of these companies. Essentially, what the refusal to deal doctrine says is that any company has the right to deal with who they want to, and they don't necessarily have to do business with their competitors. So in other words, a competitor ad exchange working with Google's publisher ad server. And that can often work, but in certain cases, the conduct of the company goes beyond just sort of what's covered by a refusal to deal, and it becomes an unreasonable restraint of trade. And that's where you sort of get past that. So what Google tried to say is, well, this isn't unlawful under the antitrust laws because we don't have to do business with our competitors.
Folks, here at Bloomberg, we have complete transparency amongst all employees. We know where everybody is all the time. It's called the out function. It's the calendar. I look for Justin. I'm like, where is this guy? And he's based in New York. But he's down in D.C., and I go look at his calendar, which is the out function, and it's something called the FIC versus Meta trial, another technology company. Why are you down in D.C. for this trial? What is this trial?
This is the topic of the week, I feel like, Paul, right? So the FTC is suing Meta right now, seeking a divestiture of Instagram and WhatsApp for the actual acquisitions of those companies they're arguing was anti-competitive. But as we all know, they've owned these properties now for well over a decade. And I have to say, seeing Zuckerberg on the stand the last few days, the testimony's been really, really strong. He did a great job fending off a lot of the criticisms coming from the FTC. His case, I think we both thought, Jen and I, was already not necessarily the strongest. There's a lot of holes there. I don't think they really defined the marketplace the right way in terms of positioning Meta as, a monopolist. So there's a lot going on. It's big tech on trial, I think, everywhere you look these days.
That's right. And now it's not just Jen. We've got a bigger team of litigation analysts. Jen, as you sit back here, in your experience, are these tech companies at risk, do you think, from the courts?
Absolutely.
Okay.
Look, you're at risk. There are liability decisions now, 2 of them against Google, right? And in both cases, the Department of Justice is going to ask a judge to force it to sell assets. And as long as that's out there, those companies are at risk. Now, would I bet that that's what's going to happen? No. I don't think that in the search case, which has a remedy hearing starting Monday, Google will be forced to sell Chrome, and I don't actually believe in this ad tech case that they'll be forced to sell off the publisher ad server or the ad exchange. But they're at risk, of course, because you have no idea what a judge is going to do. I should say that the remedy hearings will take place, decision will be made, and at that point, Google will appeal.
All right, Jen, fantastic. I tell you, folks, Bloomberg Intelligence, it's not just stocks, bonds. We've got litigation, antitrust research at BI Go. This stuff moves stocks. If you're a technology investor, you have to have an opinion on what the antitrust risk is for some of these big tech names, whether it's Amazon, Meta, Google. And we've got experienced antitrust attorneys writing this research for our Bloomberg customers on BI Go. It is awesome stuff. Justin Teresi, Jennifer Rhee, they are Bloomberg antitrust analysts for Bloomberg Intelligence. We got them, and we had them in studio today giving us some opinions on Google and Meta. You can't get it anywhere else.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, the stock story of the day to the downside is UnitedHealth Group. This stock is down 22%. That's the most in 25 years after they cut their forecast. It's their first earnings miss in over a decade. So really shocking the investors in that stock as well as the insurance space overall. So let's get some clear analysis on this. Glen Losev joins us, Bloomberg Intelligence senior equity analyst covering these insurance companies. Glenn, talk to us about UnitedHealth Group. What happened today?
Yes, hi. So United reported 1Q results, which were largely expected to be in line by the consensus, including us. And the company basically cut guidance by 12%, I believe. Initial guidance was also sort of seemed conservative relative to their long-term target. And now the new updated adjusted guidance is showing a decline of about 5% year over year. The main reason for it is the company highlighted that Medicare members are seeking twice as much care as they did the same period last year, which obviously drives costs and so on and so forth.
Yeah, they said at least John Teresi of Bloomberg News, his reporting says that the company said it was blindsided by rising medical costs. Is that surprising that a medical insurer would be blindsided by these costs? Isn't this the business that they're in?
Well, it's not surprising. It happens from time to time, but the impact based on the guidance cut is more than anyone could have expected, including them. Insurers usually look at the trends of previous years to sort of forecast what the medical costs would be in the upcoming year. And obviously, if it happens that all of a sudden, I need more care this year versus last year, people getting older, maybe some people deferred it, maybe some people changed plans, medical costs, care demand goes up, and with that, costs go up and impacting health insurers like United. So it's surprising, but it happens maybe not to the degree that we're seeing this time around.
What drives rising medical costs for somebody like United? I mean, they're the 800-pound gorilla in this whole industry. What's happening?
Well, it's pretty easy. More people are seeking more care. That's what's driving the cost. People getting sicker, with age, or people deferring care from last year to this year, for example, that increases costs. On the sort of the other side of the care demand, more people are getting prescription drugs, for example. More people are interested in preventive care versus reactive care, sort of, just going more often for checkups, stuff like that drives the costs. But it is surprising that sort of this significant jump relative to expectations.
Where does UnitedHealth go from here? I mean, just on a stock level, falling in its biggest drop since 1999. Does that move look overdone to you?
No, we're not supposed to sort of comment on price targets, as you well know, but basically the stock is down about 22% as of right now. If we take a look at the guidance cut, which was $3.50 from the previous guidance, and apply sort of historical multiple over the last 5 years, the downside should be about, maybe 60% of what it is right now, about $80 or so. So based on that, it's probably an overreaction, just because things like this don't usually happen to someone like United, as you mentioned, the 800-pound gorilla in the space, and probably the most knowledgeable people in the business. But it is what it is, and market sort of puts its own view on where the stock should trade.
I'm looking at the ANR function for United Healthcare. 27 buy ratings on the street, 1 hold rating, 1 sell. No ratings changes today, given this move in the stock. Great job, guys. Glen Losev, senior equity analyst for Bloomberg Intelligence, joining us here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, this morning, President Trump posted on Truth Social that, quote, Powell's termination cannot come quickly enough, end quote. However, yesterday at the Economic Club of Chicago, Fed Reserve Chairman Jay Powell stressed the importance of the Fed's independence and its, quote, broad support across both political parties. So we'll get a little sense here from Fed Chairman Jay Powell. Let's take a listen to his comments.
Our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So, Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties.
All right, that was Fed Chairman Jay Powell speaking at the Economic Club of Chicago yesterday. Our own Michael McKee was there, giving us some live reporting there. But certainly President Trump's tweet this morning got some attention from a lot of folks that look at the Fed and look at the Treasury market, look at interest rates and the U.S. economy. Ira Jersey joins us, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, I'm sure you've been talking to a lot of your institutional investor clients this morning. What did they make of the president's comments there on social media?
Yeah, I mean, a lot of people are just, I think that there's a scapegoating going on, right? Like President Trump might say that, I want to get rid of Jay Powell because I want to cut interest rates. But I think there's also an acknowledgement that in doing so creates certain risks to the economy. And I think from the administration standpoint, having a scapegoat on the economic outcomes is convenient, right? So if the economy does fall into a recession later this year, they can say, well, look, they can point to this tweet and say, well, the president said that he was going to be too late, and in fact he was, right? And then if the economy chugs along, you can take credit saying that all of the fiscal policies that you're doing is supporting the economy. So I think that there's a political convenience here potentially that Jay Powell remaining in office can support the administration in some way in public opinion.
So, Ira, does Trump actually have the ability to remove Powell from his seat as the chairman of the Federal Reserve? And if
I'm
not, how much longer is Powell there?
I'm not a constitutional lawyer, so right. Jay Powell probably knows better because he is an attorney. But there are some. I would suggest that folks maybe go look at some of Elliot Stein's work here at Bloomberg Intelligence, because he's been following this very closely as to the different court decisions that will lead to independent chairs and directors of independent agencies, whether or not the president can actually fire them, and what cause means. Like, how is cause defined? That's something that the Supreme Court is going to be taking up, and depending on how that goes will depend on whether or not the President Trump does. Now, let me say from an economist standpoint, and I'm an economist by training, not an attorney. There's a vast literature on why central bank independence tends to have better inflation outcomes. Doesn't necessarily have better growth outcomes, but has better inflation outcomes. So the idea that you are going to take away the Fed's independence and have an executive branch, the executive branch, ultimately run monetary policy probably means that you're going to have monetary policy that's easier than it should be at certain times, and that means that overall you could wind up having inflation and prices running a little bit hotter than it would if you had an independent central bank. Now, does that mean that you get the 1970s style inflation? Probably not, but at the same time, you could have inflation running at 3.5% or 4% instead of a 2%. And I think that's kind of a choice that both the courts, the American people, and the administration are ultimately going to have to make, even if Chair Powell can be removed for cause.
Ira, got about 30 seconds left. The ECB cut rates again today. If I'm President Trump, I'm saying, where's my Fed chairman? Why is he not cutting rates? Is that valid?
Well, a little bit and a little bit not. I mean, I think Jay Powell laid it out yesterday. And look, the Fed has two mandates. The ECB has one. The ECB's job is to make sure that you have stable prices. And if prices are falling and if there's other problems and growth is slipping, you cut interest rates. The Fed, and if you look at the U.S. economy right now, we still have 150,000 jobs per month. We still have rising wages. Retail sales weren't great, but they were fine. And so it's not obvious that the United States is slipping into a recession imminently. And I think that's the reason why the Fed is sitting on its hands, because it also doesn't know what inflation is going to do because of tariffs, and inflation expectations have been rising. If you just look at the University of Michigan sentiment survey, it shows, hey, maybe inflation expectations are way too high. So if you're the Fed, you have to balance those two mandates.
Ira, thanks so much for joining us. Appreciate it. Sorry about your Aston Villa team not making it. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. He's down there in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We had some movement from the European Central Bank this morning, cutting rates again. I think the market's even discounting another rate cut in June. Hugh Worthington joins us, Bloomberg Intelligence European rate strategist. Hugh, what did you learn from the European Central Bank this morning and their actions?
Yeah, so we had on the face of it, they came out with their statement just about an hour or so ago, saying that they'd actually removed the idea that after today's rate cut, that rates were still restrictive, which is initially seen by some as being a little bit on the hawkish side, but actually the actual press statement and then the press conference itself very much focused on this whole idea of the huge amount of uncertainty that everybody's facing, in particularly in the face of Trump tariffs. And you've got to remember, the Eurozone runs about a 200 billion euro trade surplus with America, and the focus was very much on they just have no idea what's going on. They didn't feel they'd ever have a strong idea what was going on anymore by the June meeting, and as a result, as you say, now we've actually got ourselves to a point where another cut which would be, I think, the seventh or eighth on the trot now, would be 90% priced in June, which seems pretty reasonable. And as a result, we had a situation where yields were sort of edging up on the day, and now you've got the two-year yield in Germany down 5.7 basis points on the day. It's sub 1.7%. So that's a pretty dovish outcome in the end.
Yeah, I wanted to ask a little bit more just about the reaction in the markets. I mean, U.S. yields are a little bit higher. I don't know if you're seeing any contagion of this ECB move into the U.S., or this looks like a piece of news that's just contained inside the EU.
I think it's the rate outlook in the EU versus America is enormously different. America obviously faces something possibly of a self-inflicted short-term inflation shock, but in Europe, I think the outlook is very different indeed. If anything, we're actually looking at inflation for last month came out around 2.2%, which is very close to their target of 2%. But if anything, things like energy prices, where they struck expectations for forecasts for inflation later in the year, are now much lower than they were, both in terms of oil and in terms of things like gas prices. And if anything, the ECB is probably facing more of a deflation concern and undershooting their inflation targets later in the year, rather than what looks like possibly a very different situation in America. So we're looking at very, very different markets currently, and very different rate outlooks as a result.
All right, red headline just crossing the Bloomberg terminal right now. Philadelphia Fed names Chicago Fed's Anna Paulson as president. So a new president of the Philadelphia Fed. We'll have some more reporting on that in just a moment. Hugh, how concerned are the folks in Europe about this tariff policy coming out of the U.S.? The person on the street, and you're sitting in the pub tonight.
Sitting in the pub tonight, maybe the sort of people I go to the pub with, there's a lot of concern, but generally in London, I would say people are probably looking at the moment, the headlines today, more about that they think that a trade deal with the UK is possibly 2 or 3 weeks away. I think a trade deal with Europe, though, is going to be a lot more difficult, because as I say, the trade with the UK is more or less in balance, but the problem you've got is in Europe is they run a 200 billion euro trade surplus with America. 100 billion of that is in Germany alone. So it is. I think people are much more concerned probably in Europe as to in the capriciousness of Donald Trump with those sorts of numbers that you look around as to how easy it would be probably to find a deal. And they definitely feel like that at the ECB. As I say, they've made it very clear at the meeting today that come the next early June meeting, they don't feel like they're going to be in any way better in any way, shape or form as to exactly where tariffs are going to be and what's going to hit them.
So what would get in the way of that final cut in June?
I don't think a great deal, to be perfectly honest. I mean, I can't see, a few weeks ago, everybody was focused on where do you think the neutral rate is going to be in Europe? And they were saying, somewhere between 1.75 and 2.25%. And the tone today's meeting was just one of complete uncertainty. You might as well sort of tear up the idea of where neutral rates could possibly be. People are adjusting their rate expectations down. I think you're probably looking at, as I say, at the moment, the market's pricing a rate of around 1.75% by year end, but they're also pricing about a 75% chance that could come down to 1.5%. And I think that seems, certainly, almost, well, it's our expectation. And I think that's where we are going to end up with rates, markets going to be pricing, by come that June meeting, I would have thought.
A couple of weeks ago, we were talking about Germany and some other European countries reinflating their economies with fiscal stimulus, infrastructure, defense. Is that still a story that you talk to clients about?
Oh yeah, 100%. You know that there is a lot of fiscal splurge going to be coming, particularly in Germany, but it's going to take an awfully long time to put that together. That's not going to be a story really fully for this year, probably not even next year. You know, it's going to be something which is going to take years and years and years. Now that may well be something that means that the outlook for rates could be a little bit more volatile, but really it's going to be sort of in years 2 to 3 onwards, rather than in the very short term. In the very short term, the impact is going to be there's very little growth around in Europe. The Bundesbank currently expects growth in Germany to be about 0.2% in 2025, and that's actually was cut, you know, from 1% just a few months ago. So I think the very short term, yes, there is going to be fiscal spending and infrastructure spending, but it's going to take probably this is going to be like a 9-10 year project, and it's going to take a long time for it to come through. It's not going to be coming through in the next couple of years that much.
All right, Hugh, thanks so much for joining us. Always appreciate getting a few minutes of your time. Hugh Worthington, Bloomberg Intelligence, European rates strategist.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.